Aloha, everyone, and thank you yet again for joining us at Living in Hawaii. And we are excited to share something that is extremely important, heavily daunting, and critical to your success in keeping your home and making sure that you're paying your bills on time. We spend all this time getting you into your perfect match, and we want to make sure that you understand the taxes that come alongside of it. Now, as real estate professionals, we're not here to give you tax advice, but we can give you information that we know top of our minds to give you the information to keep your transaction running smoothly and the success of your home long lived. So, we have a special guest. We have Patrick Chandler from Oahu. And we
Aloha.
also, aloha, Patrick. We are so privileged to have you today. And Miss Mara from Big Island, Hawaii.
Morning, everybody.
Good morning. Okay. Now I am representing Maui County, and we have no one here yet from Kauai, but we will absolutely put some information into the additional notes with this video about the Kauai. And did we miss anywhere else? No, we have everybody represented. So we'll go ahead and dig in. Taxes. How do we all feel when we hear that word?
Oh man, what they say is the death and taxes the only thing you can count on.
Yep. Death and taxes and change. I think that's the only other thing.
But it's a necessary evil because this beautiful islands that we live upon, we've got to keep it clean. We've got to do things with the infrastructure, and the only way that we can do that is by us all contributing to the common good, and that's through our different taxes. So it is what it is, and so
Agreed.
we can't escape it. And if we didn't have it, the place where we are right now wouldn't be as amazing as it is.
Well said, because we want to keep paradise paradise. And that is, as you said, a necessary evil. The thing that I think is most important and what we're going to be sharing with our viewers today is the nuances of taxes and the differences in tax rates. It's not like a sales tax where you could go anywhere in the United States and you'll be able to say, is there a sales tax? Is there not? The sales tax is X amount percent, and that's it. There's not a varying tax rate, where our taxes for property, depending on the property, is extraordinarily variant. And depending on your particular way of ownership, that's extraordinarily variant. And then from island to island, that's what, honestly, for me, when I was doing research for this show, was really, truly astronomically different, how each island has its own tax rate. So I'm going to go ahead and welcome Chandler to the forefront of this conversation. Could you tell us a little bit about your background, who you are in this world, and give us some insight on how you're going to be helping us guide through the Oahu taxes today?
So yes, moved back to Oahu back in 2016. I am involved in real estate. And one of the things that drew me to our presentation today is I actually volunteer with the city and county of Honolulu, and I am one of the representatives on the appeals board for the Real Property Assessment Division. So this is the board that if you are a homeowner and you get your tax appraisal amount of what the county thinks your property is worth in December, and you don't like that number, you think your house is worth less than that, and you want to reduce that, then you would file an appeal. And then you would come in front of me and a couple of other citizen volunteers, and you would present your evidence in your case to try and get your property value reduced. And then, of course, the county would present their case, and being part of that board, we would then decide either for you, for the county, or somewhere in the middle. So in the last 2-3 years that I've been on this board, I have learned a ridiculous amount of property tax, even more so than being in the real estate field. It's been definitely a crash course. And I've seen all kinds of weirdness, and it's been an interesting ride. So looking forward to sharing what I've kind of gathered over the years.
That's incredibly valuable for us. And, you said something about the assessed value. And I find it funny, as most sellers, they want to have the highest value when they're selling. My property is worth so much. However, when it comes to taxes, it's that my outside is not taken care of. I look like I'm a shack on the outside. So when you drive by, Mr. Assessor, please don't notice that I have all Bosch appliances and a whirlpool and, all the wonderful things in the home. So I'm sure you could tell us some stories about how that all pans out. But I do want to get into, how do people have an assessed value? And how does that assessed value of their home, residence, condo, can we break down the differences in between how residential versus condominiums are assessed? And we'll talk about that and then go into tax rates.
So in Honolulu County, it's all done. Well, first off, it's initially done through computer modeling. So there's no way a physical appraiser can manually go around and look at every property. Every it's just not humanly possible. There's not the budget for it, is the short answer. So they do use a computer model, and it's based off of comparable sales. So how much the homes in your neighborhood are selling for is the data that they work off of for calculating how much they think your house is worth. So now, of course, the appraisers, they want to get it right. So if you don't think the value is right, they will work with you. They want it to be right. So if there's some obvious, and the appraisers do get it wrong, the computer is not perfect. And I can only speak to Honolulu code, County of Honolulu code. They're allowed to be off plus or minus 10%, because appraising is not an exact science. It's, science and art to it, as those of us in the real estate field know. So they are allowed to be off. And your job as a citizen, if you do want to dispute that value, is to show that it's more than 10% off.
Right. That makes sense. I've seen some homes here in Maui that, as you know, Maui, or maybe you don't know, but I will tell you, Maui County has an average sales rate of residential right now about 1.1-ish still. And you said this yesterday about Oahu. It's still the same here in Maui. However, there's some areas that have very varied home rates. So if you're in a residential area, a neighborhood per se, and your comparables are selling at higher than your home sale, maybe because there's been improvements either to the left or the right of you or surrounding you, and that's what is driving your home value and assessed value up, and you haven't done those improvements, then you're going to look, according to what Patrick is saying, the same thing here, is that your value, perceived value, is higher. So we definitely implore you in all areas, because we are dealing with so many higher end homes in most of the areas of the islands, is to take a conscientious look at your tax rate. It's not your cell phone bill where you think it's datas and fees that you can't understand. You can call each county that you're in and talk to a representative and look at it. And I implore you to do that, because it is important, and it changes often because of the sales around you. Is that correct, Patrick? This is not a one and done. You don't, correct. Or Mara, please jump in on this. This is not a one and done tax rate. You own the house and it's the same tax forever and ever, because it fluctuates, correct?
Very much so.
So tell me about that in regard to, have you seen, Patrick, where your property value increases? And I don't know if it has ever decreased. Has it ever decreased for people? I don't know. I don't think but it does increase when they do a reevaluation. Is that correct?
It can go either way. Absolutely.
Oh, really? A decrease, unless. Okay.
So if the market, if prices are going down, then yes, the value of your property will go down with the market. For the assessment. So again, they're running off of comparable sales. And that's the same with anywhere in the country that is using this model for valuation, because property taxes are generally calculated the same way throughout the country, more or less. And a lot of the times it's tied to the value of the home. So yes, if the market changes, the value changes, the taxes changes. So, and it can go either way. What we're seeing right now on Oahu is our condo market is actually softening significantly. Yes. So I'm anticipating in the next year or two, because of these sales, they're going to reflect in the new assessments. I think the property tax values on a lot of our condos is actually going to go down here in the next year or two.
Do you find that the condo market, Mara, is softening over on Big Island as well, or are you dealing mostly with residential there? And how's
The
the
condo
market?
market is definitely softer for various reasons. So I think I agree with Patrick. We're going to see the same thing here.
And the same thing here on Maui for sure. We've been dealing with the transference of whether or not the short-term vacation rentals are going to be going into long-term. And if that is the case, that does affect the tax rates. And we're going to start breaking down the tax rates and such. But I do want to just continue to flesh out one more thing is when are tax rates adjusted? Is it annually? And is there a date that we should be telling our viewers to be very, very mindful of and put on their calendar and circle, circle, circle to make sure that they have everything that they need in before that time?
Well, on the Big Island, February and August are your payment deadlines. January 1st is when your new assessed value goes into effect. So for the most up-to-date information, just always be checking the real property tax website, because they do actually update. The county's been really good actually about updating all of those things. So if you just Google real property tax in Hawaii County, make sure you go to the hawaii.gov and not a .com site, and you will have all the latest, greatest information.
So take that into heed. .gov, not .com. And that is where we, as real estate professionals only, are guiding you to do your own due diligence to the government site for real property tax. Thank you, Mara, for that, because that is a huge differentiation. And I've seen some people, get their information in the wrong places. So that's perfect guidance. Now on Oahu, is that following the same dates, February and August for payments, and your due date for real property tax, January 1st? Is that the same?
Little different. The tax due is the same. So yes, February and August, that is also the same here. When you get your tax bill, and if you're not paying it through your mortgage company and you're paying it directly because you own the property outright,
Right.
then they split that bill in half, and you pay half of it in February and half in August. The thing to keep in mind, and I'm not sure how it is on the Big Island, we don't run off of a calendar year, we run off of a fiscal year. So that's one thing that people, it kind of messes with your head a little bit. It's not a calendar year. So when you talk about your 2024 property tax year, it's the 2024 fiscal year, which is actually like 6 months ahead. So whenever I look at property tax values, in regards to comparable sales and the value of a property, you always have to filter it with the mindset that it's outdated. It's probably safe to say a year behind. So you can't really use that as your Zillow estimate, for lack of a better term, on valuing property. So it's a good reference point, absolutely, but by no means do you want to use that as the way for you to calculate what you think your property is worth. So definitely lean on professionals to find that out. But the property tax value is outdated by the time it actually hits the records. But going back to dates, another important date is in Oahu, December 15th. That's when you actually get the notice in your mail. Hey, here's what your value is for the next year. Okay. And then you have a 30-day window to appeal. So you've got till January 15th to file an appeal to dispute that, because then that will kick in the next fiscal year, which is in the middle of the year moving forward. So all the stuff is trying to be handled before the city council meets to do all of their budgeting and things, because they have to figure their budget out based on how much money they think is going to be coming in. So the property tax division is kind of scrambling every year about that December or January time of year to make sure everything is wrapped up so they can send over to the city council, hey, here's about how much money you can anticipate to bring in so you can start writing checks. And so the timelines are very strict. If you miss them, it is very difficult to
retro.
Well, you probably won't get any retro.
Right.
It's very difficult to appeal to still get your case heard if you miss a deadline. You would have to have a significant
Extenuating circumstance.
chance to get that done. And since our county does a lot of stuff online now, most of the time they'll say, no, you could have done it online. Not good enough. So, oh, you were traveling? You got internet, right? You could have filed this online, and it's not hard to file these forms. They're super easy to fill out. So there really is no excuse for missing the deadlines unless you are like truly incapacitated in some way, which we've had those cases. So yeah, but back to a timeline. So September 15th is important because that's when you actually get the notice. January 15th, that's when your deadline to file an appeal. February and August, that's when the bill comes in. Another important one on Oahu is property tax exemption.
That's definitely a huge piece that I want to talk about. Can I put a pin in that one before we go there?
I'm just going to give the date.
Dates. Okay. Yep. Go for it.
September 30th. And the reason why that date is before the December date is because, again, the county needs to do things in a certain order for the math to math. And they need to know everybody who's filed for their exemptions before they send out the notices on December 15th. So that's why things are done in that order. And a lot of times people get their notice on December 15th and go, hey, I don't have my exemption. And then they've already missed the September deadline. So we run into that so much.
Oh, I can so see how that happens.
But I'll save the
details on that,
when we get to that portion of the conversation. But I just wanted to, since we were talking about timelines.
You're right on. It's all good. So I do want to go back to the fact that we have the deadlines for the value and the taxes. Now, we have buyers that buy a new home all throughout the year. We were talking about the fiscal year. So as you were speaking, it's about the year prior. So Patrick, Mara, you guys, Patrick, you're the seller. Mara, you're the buyer. Mara closes on November 12th. And her tax responsibility for the fiscal year is based off of you, Patrick, correct? Because you're the seller. And for that first year, her taxes are based off of, the first fiscal year is based off of your ownership. So if it's a specific kind of home where it's owner occupied, well, peaches and cream, everything's jolly. But if it's a rental, out of state rental, and she's an owner occupied, and you could both speak to this, what is the new owner supposed to be aware of, and how can we guide our viewers into this little nuance, which happens very often, or the other way around, vice versa? It's an owner occupied, yay. What's the difference in between that when the seller is one thing and the buyer is another? Can you speak to that regarding taxes?
So on the Big Island, and this is all dependent on whether the homeowner actually filed their homeowner's exemption or not. It's not automatically granted. You do have to do, like Patrick said, very simple piece of paperwork, but you do need to file it. If that's all done and they're getting the homeowner's exemption, their taxes are about 60% of what a non-exempt home would be. And so what we try and do as the buyer's agent, and what the escrow company is also really helpful with, as well as a good lender, is we try to give you that paper and say, hey, this is what you need to fill out, turn it in the day you close, because that's the surest way.
Let's get that in there. On the day you close,
in
your exemption paperwork. Go ahead.
You have more important things to do than get your keys and move into your new house. You've got to file that exemption. And what I recommend, because I've actually had this happen, is don't mail it. You want to walk it in, or if you do email it, you want to make sure that you get some kind of confirmation back from the county so that so that everybody's on the same page and everybody knows that you did, in fact, file that exemption. And that is the quickest way. Now, like you said, it may still take the better part of a year for your taxes to change if they need to change. But that is the way to make sure that you are going to get the tax rate that you should be getting. It's just file that paper as soon as possible.
Right. For that next cycle, right?
Exactly.
So that's
Exactly.
everybody's job in the transaction to explain the timing, because I've had some of my clients or clients that I've heard of that don't file their exemption. They scramble and then they lose the opportunity to have that exemption. And with that, that could be like 10,000 plus a year that they could have saved. So I'm really glad to hear that the team is really pushing that on that day. It's more important than keys.
And for the viewers, it is so critical that you get that paperwork filed on time, because there is no going back. I have never seen Hawaii County issue any kind of grace or anything like that.
No
if exactly, no credit. So the thing is, if you don't file that exemption by the time period, by the deadline, you are stuck with that higher tax rate until the next year comes around.
That's true.
And so, like you said, that's about $10,000 easy in 1 year that you were liable for because you didn't file one paper. So make sure you get that paper done.
Seeing that we're talking about the buyer and seller variances, thank you for all that great information, Mara. When we're talking about the buyer and seller differences, when we have a homeowner, now we're talking about exemption. We have a homeowner exemption. Speak to what the homeowner exemption is so people know what that is when they move here. Anybody?
So in Honolulu County, when your property is given a certain value, if you own the property, you live in the property full time, and you can give evidence of that, you are eligible basically for a discount. That's the short version. And that's what the home exemption is. They actually subtract X amount of dollars from the property value before they start multiplying it to figure out what your tax bill is. So it's basically
it comes off the top.
Comes off the top. So round numbers, if your house is worth $1 million and you're a married couple, they will subtract $120,000 off the value before they start doing the math. So
that Oahu County only?
And those numbers change depending on legislation. Because our values have spiked so much post-COVID, there is legislation as we speak to increase these exemption amounts. Also, over 65 has a higher amount. Disabled veterans pay a different tax rate. In Honolulu County, they pay what's called the minimum tax, $300 a year for disabled veterans that are 100% disabled. So owning property in the state of Hawaii, if you're a disabled veteran, is sweet. So it's a really good deal. And going back to the reason you want to file for this exemption, if you don't file for this exemption in Honolulu County, your property is reclassified into a different tier, which gives you a different tax rate. So in Honolulu County, there's residential, which is your owner-occupied residential, and then they have what's called residential A. And residential A is your single-family home that's being rented out. Somebody owns it, but they either don't live in it full time or they're renting it out. So I like to think of it as like the investor property tax class. And
why would they make that assumption to jump it into A if you just didn't file? What is the reasoning there?
Money.
Oh, too bad. It almost feels like a penalty. It's like, oh, you forgot? We're jumping up your taxes and putting you into a new class.
Yeah. And personally for my family, so like when we bought our home on Oahu, we actually closed in November of the year. So we missed the September 30 deadline. Right. And the previous owner was renting it out. And so it was in residential A category. So we had to suffer for a year paying the higher tax rate until the next fiscal tax year, even though we filed immediately at closing. Yes. Ouch.
This is exactly what I was talking about. When the variance is real, when the seller is a different type, and it's harder when it's a rental to an owner occupied versus an owner occupied to a rental. Because Patrick, as you said, you suffered with the higher tax rate for a year. And if it were the other way around, where you were the renter, not the renter, but you're planning on using that property as a rental, and they had the owner occupied, well, then you're in groovy for a year. Correct? Yeah.
Correct. And one other thing to keep in mind about this, Oh, I lost the train of thought. It'll come back to me. Never mind. We'll move on to the next.
No worries at all. It happens sometimes. Like, oopsie, didn't mean to interrupt. Well,
So I think one other important thing to note is when you're buying a property, if you are buying it from a veteran, because actually on Hawaii County, we're actually even cheaper. It's $200 a year. And so if you see taxes for $200 a year for a residence, it's a little different if it's vacant land. That is the bare minimum you're going to pay for any plot, no matter what size. But if you are not a veteran and you're not going to get that exemption, you need to factor that in, because your property taxes will increase significantly once that veteran exemption runs out. So just be aware of that as well, that, it's something to think about when you're in the purchasing process, not after. Just make sure that that's all accounted for. And a good lender is going to look at that and factor that into everything during the escrow period. But just be mindful of that. If you see oh, great, this property is only taxed $200 a year, it's probably too good to be true, unless you're a veteran.
I love that. That was such
just
a
be mindful of it.
Mm-hmm. To really look at what was and then be prepared for what will be. And as you said, a good lender will definitely guide you through that to make sure that you have the right finances to be able to pay those taxes, because we don't want to get into a position where, you're not able to because you misbudgeted. But I don't think anybody in the process would allow anybody with salt would allow them to go through that. But it's always good to have that extra guidance for sure. When we were talking about the different exemptions, we started to talk about a married couple. Now, you had said, Patrick, that it's $120,000 for a married couple in Oahu, correct?
Correct.
Is it the same in the Big Island, Mara?
I don't believe we have any married couple exemptions. It's either your primary residence or it's not your primary residence.
So it doesn't matter if you're a single versus...
I will have to double check on that. I don't believe so.
Because I do know here that we have a $200,000 homeowner exemption. And I believe as well that there is a married couple exemption that's higher. So we have to get those exact numbers and make sure that we have that clarity, because we've been told multiple times that, as you said, it's a homeowner exemption, but then I've also heard a married couple versus single are variant. So it's good to know. And then let's talk about the in-home residential rental 12-month lease rental exemption. Do you have that there in Oahu as well?
So there is a dedication that you can get if your renter wants to pay the property tax. So this typically happens if you're renting to a family member, is usually the situation where we see this. But then the lease needs to be like a 5-year lease. So that's how it works in Honolulu. So like if you own a property and you're renting it out to your kids, whether it's for $0 or $1 or something really inexpensive, but because it's a rental, you would normally be paying that higher property tax. But if the renters are going to pay the property tax instead, they can file a form and file for the home exemption as well, and everything will drop down. So you'll get that lower tax rate. So this is usually a tool that is used to lower taxes for the parents of kids, and that the kids are renting the house from the parents. And it's a way just to help with the family budget.
That's one of those tips and tricks.
Leveraged mostly out here.
Beautiful. We do not have that here. We have something a little different. It's called long-term exemption for a 12-month lease, that we can file that, and we require anybody that's going to do a house in Ohana, if they're going to rent that Ohana and they have a 12-month long-term renter in there, has to be 12 months or more, they can file that form plus their personal exemption, because now they're residential owner occupied, and on that same plot of land, they have a long-term renter. And that's the long-term renter exemption and their personal exemption. So that's typically a $200,000 for the homeowner, and then an additional $100,000 for the long-term renter credit, because Maui is trying so hard to have long-term rentals that they're giving incentives to the homeowners. As here, we have many, many, many properties that have enough square footage where they can have the main house and 1 or 2 additional units on the land. So that's very it offers opportunity for additional savings that we need to remind people. Make sure you get your long-term rental forms in, because that's more money off the, as you said, the top, right off the top.
Yeah, we don't have that exemption on Oahu in the Honolulu County.
But I like what you said, because I didn't even know that existed for if you rent to those little caveats that we have to know about. Mara, do you have anything on the Big Island that fits in either of these categories as far as an additional exemption?
So on the Big Island, we do things a little differently. We do have an affordable rental program, and we also have a long-term rental program. So if you are renting your property out for under fair market value, you can qualify for some tax exemptions. Same with the long-term rental. If you are renting, and our rent long-term is considered to be 6 months or more. So again, all that information is on the website. Not going to go into too many details, but go ahead and look it up. And what that's going to do when you file those applications is that's going to lower your tax rate. It's not going to give you an off-the-top exemption. It's just going to lower your tax rate. But food for thought, it lowers your tax rate to about what a homeowner tax rate is going, a primary residence tax rate is going to be. So it's about 60% of what a normal residential tax rate will be. So, so you might not be collecting as much from an affordable rental, but you are saving a bunch on taxes. So keep that in mind if you are about to put a rental unit on the market on the Big Island.
This is amazing, the variances in all of these places. I think I've said that word so many times during this interview. It's very varied. So it's important for you to decide which island you want to be on, and then dig into what the tax rates are, because now we're going to go into a whole other level that has a very large scale of variety to talk about. We're going to talk about the how do I even describe it? It's the percentage of how your home is taxed. Oh, this is where it gets heavy. Patrick, you need to help me in this one. It's the percentage of how the home is taxed.
Math.
It's math. We're gonna math, people. Get ready, get your calculators out, and just get your cup of coffee and dig in, and let's learn together. So we're going to talk about the different tiers and how the price points of a home changes the percentage of the tax, and how that's what it's based off of. Is it per 10,000? Is it per 1,000? So can you give for Oahu a clear picture of how the taxes are based off of the cost, per what number, and at what price?
The high level answer first is property taxes are calculated based on what the property is used for. So let's get that off the table first.
Yes.
So and what they call highest and best use. So whatever the best potential use for your property is what they're going to maximize you paying for. So for example, you buy a condo in the Ritz-Carlton, because you can do that, and you want to live in it.
Right.
Unless you file the appropriate paperwork, they're going to tax you at the hotel rate, which is one of the highest and most expensive tax rates there is. So you definitely want to file the appropriate paperwork to get that changed. So that's what we mean by like highest and best use. So, and there's all the different classifications: commercial, hotel, that are significantly higher than residential. The good news is Honolulu County, I can say, has one of the lowest owner-occupied residential property tax rates in the entire country. So, which is amazing.
Do you know what that is?
It is $3.50 per $1,000 of value.
Does that change in the $3.50 based off of the assessed value of the home as it gets higher and higher in the value? Or does it stay the same?
Owner occupied. No, it stays the same forever for the whole. There's one tier for owner occupied.
So you're so lucky in Oahu. People listen, Oahu. Wow.
But if you get reclassified into residential A, it's a whole nother monster. And I use the word monster appropriately. because it gets really pricey really fast.
So
on
it
the,
jumps for rentals and investors significantly. So if you're
Correct.
there to live as a
Or even-
homeowner,
or even non-owner occupied. If you're
Oh,
buying
let's
your
talk about that.
vacation home,
Mhm.
but when you're not using it, you just lock and leave, same deal. You're going to pay that higher rate.
Because they're seeing it as a rental at that point.
They're just seeing it as non-owner occupied. It's one bucket.
Okay, very
So,
clear.
yeah. So whether you're renting it out, you're not renting it out, if you are not an owner occupant resident, you're in the higher rate, period. No ifs, ands, or buts.
And it goes to that residential 1 or A, correct? It goes to the residential A immediately.
Correct.
Okay.
And so residential A is $4 per $1,000 for the first $1 million of value. So not too much off from normal residential. So what happens is a lot of people buy a property that's maybe just under $1 million in value, and they're like, my tax bill's not bad. And then the values appreciate over time, which, surprise, happens here in Hawaii. And then they get that next tax bill 3 years later and whoa, what happened? Oh, you didn't file your homeowner exemption, silly.
And now the value's higher, and it makes a huge significant dent. It does.
Exactly. So then there's that significant bump that happens with that. And so it's at the second tier where we see that multiplier kick in, where it's and the way it works is you pay the dollar amount for the $1 million and below, so that $4 per 1,000, and that's calculated. And then every dollar above the $1 million is calculated at the higher rate, and then those two numbers are added together.
Oh, okay. So that makes a whole other clarity that I never knew, that you have the $1 million and below. Let me just repeat what I heard, at that lower tax rate. And then anything above the million, whatever is assessed, say it's $1.3 million, that 300,000 is taken as the newer above that tier as a second tier rate. So it could go from say $4 to $4.25, $4.50, whatever that is, and that those two numbers are put together. Do you find that that's the same way that things are taxed over on the Big Island, Mara?
If you were in regular residential, it's similar. The amounts are a little different. So for $2 million and less, it is $11.10. For $2 million and more, it is $13.60.
And that's for a homeowner, or is that for a non-owner occupied?
Non-owner occupied.
Right.
So if it is owner occupied, if they've got that homeowner's exemption, it's $5.95 per $1,000 of assessed tax value.
And that is not on a sliding scale? Is that the number that's there for any value? So say it's anything under or over $1 million, it's just that amount for an owner occupied. And then the variant changes when it goes to a non-owner occupied. Those are some steep numbers for non-owner occupied, may I say? Oh my goodness.
And Oahu, our numbers are similar to Big Island on that. Our tier 2, the $1 million calculation on that 300,000 that you used for an example, is at $11.40 per 1,000.
Woo!
And it's it's really easy for your tax bill to double with very little effort once you start getting above $1 million if you don't have that home exemption in place.
So we've talked about your own home and then non-owner occupied, but what do you notice for a second home, which is still very common on all of our islands? When we have a second home rate, I know it's a non-owner occupied, but maybe it is. Maybe they're there for 6 months out of the year. Does that qualify them, even though it's a second home? Is there a different tax rate for second homes?
Not on Oahu. It's just the residential A and residential. That's it, A and B.
So do you have to prove that you're there 6 months out of the year, or 6 months and a day out of a year, to claim that owner occupied, even though it's your second home?
Yes. Like some of the criteria is like having a state ID. You have a Hawaii state driver's license. You have you've filed taxes in the state of Hawaii. You have utility bills in your name on the property. So there's different ways that the county will ask you to submit stuff. to show that you're
A
actually living
resident.
in the property and a resident.
Hmm. And Mara, do you find the same thing to be true for second homes there?
Well, I actually have a property that has that is my primary residence and has an additional unit on it. So the way that Hawaii County is taxing me is they are giving me a primary residence discount for half of my property and not for the other half of the property. So that's how they're handling it here. So kind of depends on the situation. I mean, a snowbird would be a little different, where they're here less than, like, I believe it's like Patrick said, if they aren't here for more than 6 months out of the year, they can't qualify for the primary residence exemption because it's just not their primary residence. So then they would be in the regular residential tax rate.
That is interesting about your specific property. I want to dive into that, but I don't want to get too personal because we're running out of time here and I want to get to some other points for sure. We talked briefly, Patrick, you shared something very quickly about over 65 and also about the military and permanently disabled military. We talked about a couple other classes, as we would say, that affect or help or change our tax rates. So when we're looking at age-based, it's what is the age that starts creating a tax potential credit? What is the age?
65.
Okay, and that is true across all counties, is 65. So 65 and older, I think you said that they're taxed, did you say higher or lower?
So they get a bigger exemption.
Bigger exemption. So they have a higher exemption. Okay.
Yeah, bigger discount.
Good, because I was like, what? I don't think I heard that right. Because why would we be penalizing our elders?
So under 65 is 120,000. The over 65 is 160,000.
Good. Yep. And then do you have that tax variant exemption over on Big Island as well? That the Kapuna actually have a higher?
I know just from from family members telling me about it, but I'm sorry, I'm not seeing exactly where or what forms need to be signed on the website, so I can look into that more. Yes, we have something similar.
Good. I love the fact that you said that you have an affordable housing discount, so I'm sure that they'll take care of their elders as well. Somebody had some background noise there. Who is that?
I'm so sorry. There is a leaf blower outside. Of course, they have to do it right now.
No worries. If you could just mute for a moment.
Will do.
Thank you, my love. All right. So we were also talking about how to leverage your exemptions. There's one that we haven't talked about yet as far as leveraging your exemptions, and that is your agriculture plan. Now, I know that not everything on the islands is big city. Yay! We do have rural. Yay! We have things that we can have the agriculture set. Now, with the agriculture land, it's zoned differently, and it also provides you an opportunity to have new tax exemptions based off of what you do with that land. So, Patrick, in Oahu, I know you have to deal with a lot of city, but I know North Shore has some country. Do you have agriculture plans, and what do they look like as far as exemptions?
So really, that it just ties back to value. So the agriculture lands are just valued at a lower price point.
Oh.
So that's what drives their tax rate down. They're actually taxed like vacant ag land is actually $8.50 per thousand. So it's actually not a low tax rate, but because their value is considered less because there's no improvements in regards to like housing and things like that on there, because the value is down, what you pay is less, not because of the tax rate. If you applied that tax rate to a single family home, you'd be going, oh. So that's just how it works here on Oahu. I'm not aware of any special programs for exemptions or additional play. I was reading an article the other day where at the state level, they're pushing a lot of things out, but I don't know how that's impacting boots on the ground out here yet.
Right. So you don't have anything, as far as you know, at this point that's for, say, a farmland exemption? No. So Mara, Big Island has to have some exemptions for their agriculture land. Please tell me.
So I am looking at a form now that I pulled straight off the county website, talking about agricultural use values and the value per acre. And so there's all different kinds of agriculture classes. We have intensive agriculture, diversified agriculture, confined animals, aquaculture and beekeeping, orchards, feed crops, pasture, good, slow rotation forestry. The list goes on and on. And for each of those, there is a value per acre assigned,
Right.
a dollar value. So depending on what you're planning to do with the land, similar like what Patrick said, highest and best use. So just go and look at that, and then you'll be able to determine how much they are going to value your property at.
And because in Maui, we have those 2 acres and above where we do have the residential, we do have the ohana, and we have enough room for the ag portion, that there's different exemptions that you have to be mindful of. So if you have a portion of your land, say it's a half acre or a full acre, 2 acres, whatever that is, and you designate it as only for planting, and you have to have a certain amount of plants, you have to have a certain amount of fruiting plants that provides food, then you also have the animal. If you have a certain amount of animals and you're taking care of the land in that way, then you have a higher percentage as well. So you could essentially have an exemption based off of that percentage of the acreage that has the ag plan, the farm plan. You can have your homeowners exemption, and you can have the exemption of the long-term rental that you have to take into play. How do all of those 3 fit together? I don't know at this point if they just take 200 plus 100 plus whatever that is and just say, here's $500,000 of off the top, as we talked about earlier. But it's definitely worth looking at. And if you have large space and land, and you know that there's an opportunity for an exemption and what that takes, it may behoove you to utilize your land to put some nurturing into that and see what else you can have to help that tax rate cut. Because as we know, the value of the home will go up, but if you can find ways to mitigate your taxes, do that. Take the time. Don't forget about your land around you, or don't forget about the fact that if you do build that ADU, the additional dwelling unit, you can potentially have a 12-month lease long-term rental here in Maui. Again, we talked about that. It's not the same on all islands, but really learn that it's not just a plug and play. You have your home, you have your taxes, that's it, we're done. If you want to save money and live long and prosper, then take the time to go to your county websites, .gov, and look into each of these little pieces, because there are so many things that change through each year. It changes through each time that they meet at the government. What could you tell your viewers for Oahu, Patrick? Something that maybe we haven't covered that you're burning and dying to talk about, that's going to give them really good information.
So one thing we haven't touched on, which I briefly mentioned earlier on, is us having the lowest tax rate for owner occupied in the country, and we didn't really explain why. And so I'd like to just take a second to sit on that for a moment, if you don't mind.
Absolutely. The floor is yours.
The state of Hawaii is the only state where the Department of Education is for the entire state. Whereas on the mainland, everybody has all these school districts that cut up the cities. Everybody wants to move into a specific school district so their kids can go to these schools because they're better than the schools over in this school district that doesn't get as much funding from the county, but the counties fund the schools on the mainland. In Hawaii, that's a state line item, budget item. So the counties don't pay for schools, which is the main reason why our property taxes are so much lower than those on the mainland.
That's a huge differentiation. Seeing that, I wonder why it was built that way. But who cares, because we win.
Exactly. We're still paying for schools with the general excise tax that we pay on everything.
Everything. Yep. Everything.
But at least it's not coming out of your property tax bill every year.
Do you have a higher percentage of short-term vacation rentals on Oahu? That's another thing we didn't yet touch about. The short-term vacation rental or vacation rentals, they have the tax and then an additional tax. Could you talk about that for a moment?
So the tax that they pay from a property tax perspective is just a higher rate. So there's actually what's called a bed and breakfast home rate that we have. And then they also would pay the residential A rate if it was like a condo or a house that they were renting out. Now, above and beyond that, there is what we mentioned before, the state and county taxes, but those are more like a sales tax that you collect from whoever is renting out the property, and it's a pass-through. So that's the only additional tax, but that isn't actually considered a property tax. It's more of a sales tax.
Sales tax. So is that what you're saying? So we have to have a GET tax for any person. That's the sales tax. Now, do you also have what's called a VAT tax or a TAT tax, a VAT or a TAT tax? It's a transient. It's all these letters and numbers. We can make a whole alphabet.
So if you're renting short term, and the definition, back to what Mara mentioned earlier, 6 months or less, is the state definition of short-term rental for tax purposes. You, in addition to the general excise tax, which is our sales tax in the state of Hawaii, you would also pay TAT or transient accommodations tax on top of that. And there's the state transient accommodation tax, and then the counties also have a transient accommodation tax. So when you add all three of these together for Honolulu, it's just under 20%. So all three of these together, when you add them up, but this is a pass through. If you have a vacation rental, your renter pays that to you and you just pass it along to the state and county. So it's not something that you're actually paying out of your own pocket. So I always tell like my clients, don't freak out about that number because it's not coming out of your pocket. You're just playing pass the buck with that, collecting it from one person and handing it to another. You're just facilitating. So don't worry about it affecting your bottom line versus the property tax.
Oh yeah.
The residential A and the bed and breakfast home rates, that's a different story.
Because that's based off of the value of the home or the unit or the bed and breakfast facility. It's not a tax for the use of. However, when we are teaching our buyers that are buying the vacation rental locations is to be mindful of your pricing. So who's taking your pricing into account? So as you go into those low months and you have to lower your rates, make sure that you don't cut your nose off despite your face. And then all of a sudden you find yourself having to pay those taxes out of pocket at that point. So making sure that it's a balance in your return on investment, that you're always covering those, as you say, allowed to pass through instead of you then having the burden of it. Mara, is there anything else for Oahu that you feel is burning and you need to tell people about taxes in any way? Patrick, before I go to Mara.
Just don't miss your deadlines. That's it.
Don't miss your deadlines.
That's the last thing that I got to say, because nothing is retroactive. They don't turn the clock back. You don't get credits or refunds if you miss those deadlines. So always get your stuff in. Oh, wait, there is one other.
About zoning, maybe?
File for the home exemption. File it with every family member that is owner occupying. I'll give you an example. So let's say a husband and wife are living in a property. They file for the home exemption, but only the husband files for it. And because us guys, we die faster than women, he passes away. But because the wife did not file for the home exemption, and of course, she gets her tax bill in December and she's like, hey, I'm residential A now. What happened? She is on the hook for those taxes for the next year. So make sure when you're filing for those home exemptions, file it for everybody in the house.
That's a great point, because I can see how that could happen. Culturally speaking, the man takes care of the woman and the family and covers that and forgets when something like that happens, because you're dealing with other issues. So yeah, that's a very good point. Thank you for bringing that up. And then did you want to say anything about zoning, how zoning does not necessarily affect the use of the property? So that's one thing that we never really talked about that is very important as well, because we see different zones here, and if it's zoned hotel but you're using it as a residence, I think you mentioned that just briefly.
Yeah, you can file for what's called a residential use dedication. And basically, it would allow you to get the lower tax rate for 5 years, but you have to renew it. So if you forget, again, you miss the deadline, you lose it for a year.
You
Until
snooze, you lose.
yeah, so don't miss your deadlines. So yes, there is a way, and like I think the example I gave was buying a condo in the Ritz-Carlton. You would do a residential use dedication, you would get that 5-year residential tax rate, and then remember to renew it in 5 years. If not, you're going to go to the hotel rate.
So is that true if it's also zoned for short-term vacation rental and that's the hotel rate. That's it. Nothing. Rewind. Edit. So Miss Mara, when we go over to Big Island, we just want to wrap up. If there's anything like we did with Patrick that you want to talk about that maybe we didn't hit that would be valuable to our viewers, and we can start with anything that's on your mind.
Well, I've got to say, Patrick gave really good advice in saying that we do not miss any deadlines, because there is no retroactive, there is no credits. If you miss the deadline, you are paying whatever rate they assign you, period, until you file your paperwork and your exemption kicks in. So absolutely, thank you for that, Patrick. Do not miss your deadlines. And yeah, it's interesting because we do see that here on the Big Island too, as far as zoning goes. Zoning is totally separate from from property tax exemptions. My personal, I live in an agricultural zone, yet I have homeowners exemptions for residential homeowners exemptions. So it's complicated. And if you have any questions, again, county keeps their websites updated pretty well. And there is an email address that you can email if you have any questions. And I actually have found them pretty good about getting back to you and giving you useful information. There's also phone numbers that you can call. So anytime you're not sure about it, I mean, you can look on the website and try and piece it all together, but it is complex. And so I always find it best to just reach out to the real property tax office, and they'll set you straight.
That is it. That's the mic drop right there. They will set you straight, because this is
and just
complicated.
to dovetail off what Mara said, they are so helpful, because at the end of the day, they just want it to be right.
Right.
And so as long as you're not trying to pull a fast one with them, they are amazingly helpful. They are not adversarial, at least on Oahu anyway, in any way, shape, or form. I get constant feedback from homeowners who have met with the county appraisers and said, he's so nice, he's so helpful, he talked me through it. He explained why, they just want everybody to know. And actually on Oahu, they do open houses where the Real Property Assessment Division goes out to the community and talks to people. And we actually have one coming up on September 13th at the Farmers Market at Pearl Ridge Mall, where the Real Property Assessment Division will be there and to answer questions in person. Wow. So they actually go out into the community. They want people to know not to miss these deadlines, not to sleep on this stuff. So they're very, very helpful.
That is huge. That's great. I wish they did that on all counties. Maybe they do. We need to find that out, because
there's that for sure.
Well, I think we've covered everything we've talked about residential, we've talked about condo, we've talked about the agricultural side for land. We've talked about the differences in between the value of the home and the tax rate, and how to kind of know that one or the other may be moving at any time. So you have to look at the big picture and know how to put it all together, and to be mindful, timely, and dedicated to your own growth and keeping your money in your pocketbook. Thank you so much for your time, Patrick. Thank you for your time, Mara. And if there's anything else we want to say, no?
Yes.
Yes, I see. I felt it in you. I was like, we want to make sure that we give you every little bit of good juice.
So here's a mind-blowing fact for you. So
Fact.
think about this. We have the property values, and then we have the tax rate. Imagine, hypothetically, world-ending, something happens, and everybody's property values, they drop in half. Now, do you think that the county is going to spend any less money the following year? Yes or no?
No.
So how do you think they're going to make up that budget shortfall?
Increasing the taxes.
They will increase the tax rate.
Right. That's what I meant. Mhm.
Yeah. So just because your home values go down doesn't mean you will pay less taxes. Trust me, city council will figure out a way to make the budget work. So
Yes.
if you really don't like your tax bill, don't blame it on the appraisers. They're just establishing value.
Right.
Talk to your city council. They're the ones that establish the rate. They're the ones at the end of the day that are going to determine what your actual bill is. So go to city council meetings, talk to your council members, talk to your politicians. They're the ones that are really in control of what that tax bill is at the end of the day. So that's my mind-blowing fact there. To my deep thought, so to speak,
Yes.
to leave everybody with,
Thought.
don't blame the appraisers, blame the politicians.
Oh, here we go. That's a whole
Uh-oh.
how about if we leave them on the do your due diligence and keep the money in your pocket?
Don't miss your deadlines.
Don't miss your deadlines. Don't miss your deadlines. Don't miss your deadlines. Don't miss your deadlines. I think we made it clear. Don't miss your deadlines. We love you. Good luck. And with a hui ho, we'll see you again on the next episode of Living in Hawaii. Aloha.
Aloha.
Aloha.